Hi everyone, welcome to this session that will cover an overview of the Luxembourg tax system as well as some recent updates. My name is Michael Ayachi. I am a tax partner in KPMG Luxembourg, but soon to be relocated in the US to lead our Luxembourg tax center in New York. I am pleased to be joined today by my colleague David Stalker, a director based in Luxembourg. Now, if we have a look to our agenda for today, we will go through some of the key features of the Luxembourg corporate tax system, but we would like also to focus some time on some more recent and hot topic in Luxembourg, which are around the transposition of the Anti-Tax Avoidance Directive 1 and 2. But just before moving into the tax aspect, let me give you a quick overview of Luxembourg. Luxembourg is a small country which is at the very heart of Europe, very well connected to its neighbor country. It has a population of about 640,000 inhabitants as of today, but that number of population increased a lot during the day with all commuters coming in to work in Luxembourg. It is one of the EU founding partners. And the economy of Luxembourg, while I was saying that it's a small country, the economy on the other side is quite big, mostly focused on the financial sector. But not only, there are some more traditional industry, being the steel industry as well as the logistic industry, with a number of big players in the country. Luxembourg very well connected to Europe, as we have seen, but also to the world. When you see to the number of double tax treaty which the country has concluded, as of today, 84 double tax treaty to support the economic relation of the country. There are more to come with 15 other not yet in force but in negotiation treaties. Now, I'd like to leave the words to my colleague David to give us an overview of the main taxes applicable to companies in Luxembourg.
Thank you, Michael. So corporations resident in Luxembourg are subject to a number of taxes. First and foremost, they're subject to corporate income taxation at an aggregate rate of approximately 24.9%. And that is split between two taxes, income tax per se at 17%, and a municipal level income tax, which the rate changes depending on the municipality. But the most common one that we usually see is the capital, Luxembourg City, at 6.75%. But companies are also entitled to a number of possible exemptions and reductions while operating here in Luxembourg. So for example, the participation exemption, covering dividends and capital gains on all things related to participations. The wide treaty network that Michael mentioned also entitles companies to exempt income allocated to PEs and sometimes certain income streams as well based on the specific treaties. And we also have an IP regime for companies engaged in licensing of or sale of qualifying IPs. Another important feature of the Luxembourg tax system is the net 12 tax, which is essentially applicable to the net assets of a company adjusted by some exemptions or non-deductibilities, and applies at a rate of 0.5% on a yearly basis every year on 1st of January. If a company has a basis that is bigger than 500 million, a reduced rate is available of 0.05%. But this tax also has a number of possible reductions and exemptions. The most important of them, the participation exemption, applicable to the shareholding of the shares themselves. And it's also possible to reduce this by a special reserve on a yearly basis, provided that certain requirements are met. Last but not least, of course, income flows may be subject to withholding tax, but in Luxembourg, only dividends distributed may be subject to withholding tax, but this also may be fully exempted or reduced based on either treaties or the participation exemption. Interest payments, liquidation proceeds, or royalty flows are not subject to withholding tax in Luxembourg.
Thank you, David. Since you were speaking about the participation exemption as one of the important regimes in Luxembourg, can you give us a bit more color on how that regime works in practice?
Gladly, Michael. So the participation exemption applies to income coming as dividends coming from the participations or from the disposal of participation themselves, so the capital gain, or liquidation proceeds, provided that certain requirements are met. Namely, these requirements are a holding period of at least 12 months that either needs to be met at the time where you got the dividend or major disposal, but can also be met prospectively if you commit to keep the holding for at least this period of 12 months. Additionally, you need also a certain volume of holding, in this case 10%, or if you don't have the 10%, you can also look at the acquisition cost itself, either 1.2 million for dividends or 6 million for capital gains. And there is a comparable tax test, which is met if a company is subject to at least half the Luxembourg income tax rate, which, since it's 17, 8.5% is sufficient to meet that. Provided these requirements are met, the company in Luxembourg is entitled to a full exemption on either the dividends or the capital gains, while capital losses on a disposal remain fully deductible in Luxembourg. Also, when these requirements are met, this also allows for the exemption both of withholding taxes on distributions made out of Luxembourg and on the value of the participations for net of tax purposes.
Okay, so that's interesting to know when a Luxembourg company derived dividend and capital gain from subsidiaries, so making profit. So what about the regime of losses? And I know how losses can be important in a COVID time. So how is Luxembourg operating with regard to tax losses? What's the regime here, David?
So in Luxembourg, we do have a regime for tax losses carry forward. This regime used to allow companies to carry indefinitely the losses, but this changed a couple of years back, meaning that any losses generated after 2017 can be carried for a period of 17 years, and any losses generated prior to that remain under the original regime and can be carried forward indefinitely, with all those losses always being used first. Another important aspect is that losses in Luxembourg, they can be used to offset any income of the company. There's no correlation between only being able to offset with the same type of income that generated or any type of so-called basket system. And another important feature here is that you can offset 100% of your taxable basis in a given year. We don't operate any type of limitation that only allows up to a certain percentage.
Thank you, David. So we spoke about company making profit through the participation exemption. We talked about the regime about losses. Would it be possible to somehow aggregate profit-making companies with loss-making companies, or are those companies always taxable on a standalone basis?
That's a good question, and it's definitely possible in Luxembourg. So for groups that have a large presence here with multiple companies, some with positive results, some with negative results, it's possible to enter into a fiscal unity to consolidate all these entities so that you can submit a tax declaration covering a single tax basis, pooling all the income and expenses from these various companies. And in Luxembourg, that can happen either if you are in a chain of ownership with all the companies being owned by the same company, but it's also applicable for sister companies, provided that they have a common parent located in the European Economic Area. So as long as you have at least 95% of ownership, either in this direct chain or between sister companies, you can apply to have the fiscal unity in Luxembourg. And this also applies for permanent establishments. They can also join a unity. One important thing to keep in mind here is that if companies decide that they want to enter in a fiscal unity, they need to commit to stay in that unity for at least 5 years. If this is not complied with, this may entail in a retroactive termination of the fiscal unity with resubmission of all taxes on a standalone basis for the period that was originally under the unity. Now, we have another interesting aspect here in Luxembourg that I would like Michael to comment, which is the IP regime. Michael is our lead specialist when it comes to IP regime in our office. So Michael, can you walk us through a little bit how does that work?
Thank you, David. Yes. So similarly to other EU countries like the Netherlands or Belgium, Luxembourg does provide a tax incentive for research and development activities conducted in Luxembourg. The regime operates as a 80% exemption of intellectual property income derived from qualifying intellectual property, which are inventions protected by patents as well as software copyright. For example, trademark would not qualify. The incentive can provide a tax rate as low as 5%. That would be in the circumstance where the taxpayer itself developed fully the intellectual property or delegate partially it to unrelated parties or to a branch situated in a European Economic Area. Now, if it doesn't fully develop the intellectual property itself, and perhaps delegate some of the research and development to a related party, or has acquired maybe some of the IP from related or unrelated party, the incentive will reduce according to a nexus ratio, which is a fraction where we have the so-called qualifying expenditure, so those basically expense which the taxpayer has incurred himself to develop the IP, divided by the total expenditure, which is made of the qualifying expenditure plus those costs which were outsourced to related party or acquisition of intellectual property. So obviously, the lower is this nexus ratio, the lower would be the capacity for exemption, and obviously the higher would be the effective tax rate. Now, if we go to the next slide, let us give you some other key features of the Luxembourg tax system applicable to corporation. So now we've mentioned an incentive applicable to intangible assets. So there is also an incentive for investment into tangible assets under the form of the investment tax credit. Here we do not speak about an exemption per se, but it would be a tax credit when certain investments are made, which will reduce the corporate income tax charge. As you may know, in Luxembourg, company can file their accounts in a different currency than euro. And the good news is that for tax purposes, they can also file their tax account and as a result, their corporate tax return in a different currency than euro, which mitigates some foreign exchange exposure. All companies would be at the very least subject to what we call the minimum net wealth tax, which is ranging between 535 euro and 32,100, depending on the asset composition as well as total balance sheet. There is no stamp duty in Luxembourg, contrary to some other countries, we don't have that. The VAT rate is at 17%, which is one of the lowest within the EU. And we also obviously apply transfer pricing legislation and the so-called arm's length principle for related party transactions. So if there is a related party transaction which do not meet market condition, our domestic rules allow for downward and upward adjustment to restate market condition. So now if we go to the next slide and spend a bit of time on the more recent tax update, because so far this was a kind of snapshot of what is the key features of the Luxembourg corporate tax system. As we look now to what happened more recently, similarly to the other EU member states, this is the transposition of the so-called anti-tax avoidance directive. So-called ATAD 1, which was also supplemented by the ATAD 2 with regard to hybrid provision with third countries this time. So which are the five main pillars which are addressing this package of measures? So we speak about control foreign companies, so the so-called CFC rules. We speak about interest limitation rules. We speak about hybrid mismatches, very important. We speak also about general anti-abuse rule as well as exit taxation. In this presentation, we will focus on 3 out of the 5 we mostly see and discuss with our clients, which are the CFC rules, interest limitation, and the hybrid mismatches. So as we go to the next slide, the first basically provision that we would like to develop a bit more here as to how Luxembourg implemented interest limitation rules, which by the way didn't existed before the anti-tax avoidance directive. So this was a new provision we had to comply with. I know there were already earnings stripping rules in other countries. We didn't have that. So how would the restriction apply according to the interest limitation rule? So we would be basically looking at denying exceeding borrowing costs, which would basically be limited to 30% of the tax EBITDA of the company. So anything which would exceed 30% of the EBITDA should in principle not be deductible. There are some exceptions to that. Loans which have been granted before June 17, 2016 would be grandfathered, and as a result not into the scope of the rule to the extent they are not subsequently changed. There is also a safe harbor, what so-called de minimis, of 3 million euro, which the company can deduct in any case, even if the EBITDA is very small. There is also another way out, which is the so-called equity escape rule, where the kind of equity ratio compared to total assets is at least equal or greater to the ratio of the group. Then the Luxembourg company can preserve a full deduction of exceeding borrowing cost. In terms of carry forward of exceeding borrowing costs, this can happen under an unlimited basis, whereas unused interest capacity can only be carried forward for 5 years. Some entities are excluded from the interest limitation rules. These mostly relate to regulated entities in the financial sector, basically. So now as we go to the next slide, for the other main provision that we very much discuss with our clients, it concerns also something new which didn't exist prior to the transposition of the ATAT directive in Luxembourg, is a so-called CFC rule, control foreign corporations. So that provision would basically look at bringing into taxation in Luxembourg any undistributed profit from a subsidiary or a permanent establishment of the Luxembourg company. And for that, they need to meet two cumulative conditions to understand whether some of our affiliates are a so-called qualifying CFC. So the two conditions are the following. There is a control test, which needs to be more than 50% that we own directly or indirectly, alone or together with our associated enterprise into the so-called CFC. So that's the first test. Second test being on the effective taxation rate. Is the effective taxation of the CFC below 50% of the effective taxation rate that would apply under normal rules? So if you answer yes to that question, you would basically meet the second condition. So if the control test is met, if the effective taxation rate is met, so your affiliate is what we call a qualifying CFC. Now, do we stop there? Does that mean that there is de facto an income inclusion in Luxembourg? Not necessarily, because the way Luxembourg implemented these rules is only in a circumstance of what we call non-genuine arrangement. And a non-genuine arrangement would typically arise if the significant people function in relation to profit and assets of the CFC are basically located in Luxembourg. And only in those circumstances and insofar of those significant people functions sitting in Luxembourg that we would basically organize a pickup in Luxembourg. So that's the way our CFC rules apply. And now as we go to the next slide, I'd like to leave the words to David for a very important provision as well, which concerns hybrid mismatches.
Thank you, Michael. So hybrid mismatches are, to put it in simple terms, situations where two jurisdictions are going to be looking at the same transaction in a different way, leading to an outcome where potentially nothing is going to be taxed or you're going to get a double benefit. More specifically, for you to have a hybrid mismatch under the rules as implemented in Luxembourg, you first need to make sure you have a mismatch outcome, which is either a double deduction, that is when you have a payment or an expense being deducted in two jurisdictions at the same time, or the scenario of a deduction without inclusion, where you have a deduction in one jurisdiction and in the other there is no recognition of the corresponding income coming from that deduction. Should you have a mismatch outcome, that needs to arise between associated enterprises or permanent establishment, or be connected to a structure arrangement when you enter into a transaction specifically with the purpose to get that result. Provided those two are met, you also need to make sure that this hybrid mismatch outcome, so either the double deduction or the dual inclusion, happens first between two different countries, so not just between two Luxembourg companies, and it is involving hybrid instruments hybrid entities, which are in those two situations, entities or instruments which legally are qualified in a different manner between two different jurisdictions. A disregarded PE, so where one country sees a permanent establishment and the other one does not, or similar situations involving this conflict of interpretation on the basis of legal norms. If you have all those situations combined, then you have a hybrid mismatch that needs to be tackled in some way, shape, or form by the parties involved. So the primary rule is that the jurisdiction where the payer is located or the source of the payment is located is the one that should solve the mismatch by, for example, denying a deductibility. But should that jurisdiction, for an example, have no similar rules on hybrid mismatches or for whatever reason not take action, then as a secondary rule to close the gap, the recipient of the income should be the one solving the mismatch. But looking at these rules just like that, it's rather bland and perhaps abstract. So let's have a look at a couple of examples where we can see how this effectively operates in practice. So let's look first at the left-hand side, common structure. You have a US company holding a Luxembourg company, which is checked open for US purposes, meaning here disregarded, and funds the operation of this entity also with an interest-bearing loan. The Luxembourg entity uses the proceeds from that loan to on-lend to some of its subsidiaries. The result from that is that in Luxembourg, since the instrument is treated as a debt, deducts the interest expense when paid or accrued in favor of the US company, while the US company disregards entirely the existence of the income because from a US perspective, they see that the loan is with a disregarded entity and therefore basically with the company itself. Because of this, we have an outcome here of a deduction non-inclusion, where you get a deduction in Luxembourg and no inclusion in the US. In this situation, Luxembourg should be the one denying the deductibility as the payer jurisdiction in order to solve this mismatch. And Luxembourg should do that unless this mismatch is offset by also a dual inclusion. So let's say if the US is also picking up a corresponding income that Luxembourg is also including to avoid this mismatch outcome. Another similar scenario is the one that we have on the right-hand side. Again, we have a US company here investing now in a Luxembourg SCS, which is essentially a partnership. From a Luxembourg perspective, this partnership is fully transparent, but let's assume here for the sake of this example that the United States sees the SCS as an opaque corporation. Now, the SCS is also receiving a payment from a subsidiary located in a country of the European Union. Now, since Luxembourg treats the SCS as fully transparent, as far as Luxembourg is concerned, nothing should be taxed in Luxembourg. That payment should just flow through and be picked up by the partner in the US. But the US, looking at the SCS as an opaque entity, has nothing to pick up. The country just considered that the income should be picked up at the level of the opaque entity. So again, we have here an outcome of a deduction non-inclusion, this time because of a payment being made to a hybrid entity. And in this case, similarly, the EU company below where the payment is sourced from should deny deductibility since there will be no corresponding pickup of the income either at the level of the SCS or the US. This example is particularly important because as from 2022, there are new rules kicking in also from the ATAD, which is called reverse hybrid, meaning that in this situation, Luxembourg would also have to treat now the SCS as an opaque entity and tax the income accordingly for corporate income tax instead of simply letting it flow and have the other country take the first action to deny the deductibility.
Thank you, David. What about payment made to a no-tax jurisdiction, such as the Cayman Island, for example? Would that result into a deduction with no inclusion?
That's a very important point, Michael. Thanks for raising it. As we mentioned in the previous slide, the mismatch outcome needs to be due to a hybrid mismatch, so a conflict of qualification on the instrument or the entity. In this particular instance where you have, for instance, a tax haven, low tax jurisdiction, the deduction non-inclusion outcome actually comes from a different tax systems, where the other system simply does not operate a corporate income tax. So there is not necessarily a conflict here on how to qualify the instrument itself, but only on the fact that it's not going to be taxed due to a lack of tax existing. So this would not, in the terms of the current legislation on anti-hybrid, be caught by the rules.
But then does that mean that a payment made to a no tax jurisdiction would always be deductible in Luxembourg?
That would be a very fair conclusion if you were looking only at the rules introduced by the ATAD. But as we can see in the next slide, in addition to those rules, Luxembourg has recently introduced also measures to tackle payments to blacklisted jurisdiction. As you may be well aware, there is an increasing push globally for transparency, for fair taxation, and for non-competition, where there is increased scrutiny now on a number of jurisdictions that have been historically considered as tax haven jurisdiction. And there are a number of blacklists in the world. So we have blacklists at the level of the OECD, at the level of the European Union, and sometimes even at the level of individual countries. So Luxembourg introduced measures following the European Union blacklist, whereby if a payment is made to an entity in that blacklist, Luxembourg will deny deductibility. This is important because it was also a possibility that withholding taxes will be included, which is something that a number of jurisdictions decided to do whenever there is a payment flowing to a blacklisted country. But in Luxembourg, what you need to do, if that country is in the EU blacklist, the payment is denied deductibility. And what's important to take into account here is that the list is applicable, is the one valid as from 1st Jan of a given year. But if by any chance one of the countries is dropped from the list, say because they increase their compliance with transparency rules as required by the Union, the listing takes effect immediately. So then as from that moment forward, there's no need to deny deductibility anymore. And last but not least, if you can justify economically your payment as being something that is business necessary, that is commercially valid, and not just something that you're doing to be able to erode the tax base of Luxembourg and shift profits elsewhere, it is also possible to maintain your deduction, but this needs to be properly documented and reflected in the reality of the company.
Thank you, David. So this closes out our presentation about Luxembourg tax system. Thank you very much for attending the session. We hope you found it helpful. Please feel free to reach out to either David or I. Our contact details are at the beginning of the presentation.